Good morning, everyone, and welcome back to Southern Wealth. I do hope you're having a wonderful day. If you do enjoy the content, the only thing I ask in this channel is that you drop that like and subscribe. That's it. Don't sell you anything. Not here to give you, if you pay this money, you can come to a private membership. No, it is what it is. I just try to disseminate as much information as I can and as I see it. As I meant, this channel, one of the reasons was to record my hopefully journey into generational wealth via crypto. Everyone should know by now which cryptos I do own and at what price I did buy them. So you will be able to join that ride. Other things is, since I have experience with other asset classes, I thought, okay, how should people look into companies from, let's say you don't have much financial experience, you didn't take courses in university, or your line of work has nothing to do with it. I would say the most proven strategy, if you don't like it, because crypto has a high learning curve, so you really need to invest huge amounts of time before you feel that you are in the right spot, and then volatility can be very difficult for people to tolerate. I mean, you can be in the right projects, but those things can go down 60 to 70% over 2 weeks. And most people don't deal with that kind of volatility very well. So, and I mean, even for me, right? So I'm very confident of the projects that I'm in and the timelines. However, when I see things go down like 50% or 60% in 2 days, I'm not made of stone. I also feel it. So, just looking at stocks in general. The idea of the financial advisors is to make it look like what they do is extremely difficult. So you cannot do it by yourself. That's the key. Of course, by the way, none of what I'm saying here is financial advice. It's just how I think, and from what I've seen, tends to work better for people. If this was for my own best interest, what I would do is something like this. Check every week the top 10 trending stocks, talk about them, pump the hell out of them. So you're going to go to $1,000 tomorrow, do all of these things, and then just week after jump to another 10 stocks, and then basically, if I was lucky and a couple of them hit, I would only talk about those specific ones, and then I would use that to sell courses, to sell memberships to my groups, etc. I could do that. It's actually not very hard to do. A lot of people do it on YouTube because, unfortunately, it works. Most people come on YouTube, they have no clue about financial content or anything, so they say, oh my God, this guy made what? This guy made 180,000 buying out of the money call options in a penny stock. My God, and they think that that's how most people make money, right? And what I've seen is, in general, what works for most people is buying diversified index funds, and you should do whatever you want, but I'm talking mostly about diversified also in terms of geography. Why? The US in 2010 to 2020 has outperformed every other region on the planet. Now, if you go back in history, from 1999 to 2009, the US underperformed everything. And if you go to the 90s, the US outperformed. And if you go to the 80s, the US outperformed in a few years and underperformed the other years. What I'm trying to say is that not every single region outperforms everything every single year. Okay? So in my opinion, having funds that have exposure to other parts of the globe, and also other currencies tends to work well if your time horizon is 30 or 40 years. If your time horizon is 10 years, I think some decades it will work in your favor, some decades it won't. But the point is that would be the best options in general. Why? Because typically, most people cannot make judgments about individual stocks. And if you do that long enough, what tends to happen is that you lose more than you win. And the most dangerous thing can happen to you is if you win big in the beginning. Because then you get convinced you're a genius, you're next Warren Buffett, you have a money printer in your pocket, so on and so forth, right? So those type of funds, you're basically, what you're saying is, I think in 30 years' time, the world will be better than it is today. So I'm going to buy all the stocks or many stocks of the world because most of them will do very well. Then those funds have very low expenses and typically they are passive investing, meaning they are not trading in and out of stocks. You see, when you buy actively managed funds, because they trade in and out of stocks, depending on where you live, you may pay something called short-term capital gains tax, which are very high in certain regions. You have countries where there is no capital gains tax, namely UAE, Netherlands, Luxembourg, what else? Of course, all the Cayman Islands and British Virgin Islands, all of that don't pay taxes. I'm thinking about other countries. There are a few in Asia that you also don't pay capital gains tax, but in other places you do. So when you have someone, actively managing funds and basically trading in and out of stocks, they tend to, over a long run, so let's say 20, 30 years, they tend to underperform the market. Particularly, they charge higher expenses and they charge, and then you need to pay, depending on where you live, but people tend to need to pay a short-term capital gains tax, which further reduces the profits. So, and then when people get older, let's say above 60, and they start to retire, there's something that sometimes happens, which is called a market crash. Sometimes stocks go down 50% or 38%, or in the case of the tech bubble, 80%. And then, so far, they have come back, but they take, let's not forget, the Nasdaq topped in 2000, and it took them until 2013, I believe, to get to the same level of 2000. So if you're a person in your 70s, that may be too late if your retirement is in those kind of stuff. So what I've seen that most people do is they start shifting to short-term bonds. So you have these money market funds, you have these treasury bills, 3 months, 6 months, 12 months. So short-term, they pay you nowadays above 5%. And for people, that tends to work very well. Now, then there is a subset of people who buy individual stocks. Now, in that context, I'll speak a bit more about that in other videos. But that is much more dangerous because you can be buying an excellent company, excellent stock, but it's just overvalued. That's it. That's perfectly possible. Let's say you bought Amazon in the year 2000 at 106. Was Amazon a good company? Yes. But then it went down to $6. That's a 95% drop. And then it eventually went to $3,500. But the point is, depends on when you buy. So you can have an excellent portfolio of companies, let's say 20 companies, 10 companies, 15, whatever. But if you buy them at the wrong time, if you don't understand if the valuation is good or if the valuation is bad, what is considered, for example, people saying, oh, Tesla will open a gigafactory in, I'm just going to throw something. Tesla will open a gigafactory in Brazil. It's going to be great for Brazil. Brazil has 200 million people. It's going to be great. And then most people think that as soon as the gigafactory is announced, now the gigafactory has opened, they expect the stock to go up. They don't understand that the gigafactory in Brazil has already been factored in the market. So because certain things, like the performance of the company over the next 12 months is factored in, people think that if good news happen on a single day, that somehow the stock will go up. But people are already aware of it. And also, of course, stocks can go to zero. Index funds, by God, index funds to go to zero, I think basically you are already living in Mad Max. So I don't think it really matters what kind of money, where you have your money invested, but indeed, when you invest in stocks, when people say buy the dip because then it goes up, yeah, that has been true for index funds, which have 500, 1,000, 2,000, 5,000 companies. And if basically one company gets out of the index, the other one replaces it. But when you're talking about individual stocks, the whole thing can go to zero and stay there. So it's a much more difficult game, but I'll give a bit. I used to have a portfolio of stocks, and they actually did quite well. And I will just say the kind of things that I used to look at. And basically, I will make a series of that for the next few videos. No worries, everything will be free of charge. You can call me an idiot at the end. You can call me blind, etc. So you see, I'm not here to give you any kind of financial advice. I'm here just to, broadcast a bit of my experience and the things that I look at. Some of them will make sense to you. Some of them will make no sense to you. You're going to be the judge of that. And I would like to thank you very much, guys, and I'll catch you in the next one.